And I'm Mira.
And it is Sunday evening, June 7th, 2026. Welcome to our deep dive.
Yes, thanks for joining us.
Our mission tonight is to unpack a really massive stack of weekend news for you. I mean, we're looking at everything from ballistic missiles in the Middle East to a surprise $35 billion AI funding deal.
Which is just a huge amount of cross currents to process before the Monday open.
Exactly. So we're going to cut through all that noise. We want to help you understand how this AI CapEx boom, sticky inflation and real geopolitical risk are all throwing markets around right now.
Right, because you really need to know what baseline you're operating against heading into the week. But before we jump in, a quick reminder that this deep dive is for market context and discussion only.
Yes, strictly educational.
Right. It is not personal investment advice or an investment recommendation.
Okay, let's get right into it. Session 1. What exactly drove the cross-asset sell-off this past week?
Well, the easiest way to describe it is just severe whiplash. I mean, we started the week with this huge AI rally that violently reversed course.
Oh, totally violently.
Yeah, the S&P 500 actually hit a record high of 7,609.78. But then it just plummeted to close Friday at 7383.74.
Which is a massive drop. And the Nasdaq got hit even harder, right?
Oh, absolutely. The tech-heavy Nasdaq dropped from over 27,000 all the way down to 25,709.43.
Wow. And just to highlight that bifurcation, the tech sector ETF, XLK, it initially jumped 14.4% in late May.
Right. Everyone was so bullish.
Yeah. But then it tumbled 9.0% through June 5th. It just completely erased that momentum.
And because of that, volatility obviously surged. We saw the VIX spike from around 16 up to an intraday peak of 21.57.
Which means the plumbing of the market was under serious stress. And a lot of that came from fixed income.
Yes, the bond market was really the driver here. The 10-year Treasury yield jumped to 4.536%.
Right.
And that yield spike squeezed the U.S. dollar index up to 100.07.
Which always wreaks havoc on commodities. I mean, we saw WTI crude oil suffer total whiplash. It spiked midweek to $96 a barrel.
Only to close at $90.23?
Yeah. And gold just crashed. It fell from a high of $4,508 down to $4,354.
So really, the entire week just exposed the severe concentration risk in this market.
Definitely. Everything is heavily triggered by those rising yields right now.
All right.
So we're going to take a really short break, and when we come back, we'll unpack the explosive weekend news that's going to dictate Monday's trading session.
Welcome back. Let's move right into session 2. How do the weekend's geopolitical and tech developments shift our macro baseline for Monday?
So looking at the watch next items from Friday's close, there are two immediate things you need to be watching.
Right, Monday is packed.
Yeah, at 12:01 a.m. Eastern Time on Monday, those new U.S. tariffs on aluminum, steel, and copper officially kick in.
Which is huge for supply chains.
Exactly. And then Monday afternoon, we get the New York Fed consumer inflation expectations, plus the 3-month and 6-month mill auctions.
But to really understand those catalysts, we have to look at the macro foundation that was poured on Friday morning.
The jobs report.
Yes, the May employment report at 8:30 a.m. Eastern Time. It just completely shattered expectations. The economy added 172,000 jobs when the expectation was only 88,000.
Right, which means the economy is still running incredibly hot. And, with the Shiller PE ratio sitting above 40 right now and S&P profit margins so concentrated in tech,
The market is priced for perfection.
it really is. So the prospect of rate hikes or just higher for longer yields means we're dealing with discount rates as financial gravity. It's just pulling down those stretched valuations.
That's the perfect way to phrase it. And that gravity is getting stronger because of what happened Sunday morning in the Middle East.
Yeah, the geopolitics are getting intense.
At exactly 8:15 a.m. Eastern Time, Iran fired waves of ballistic missiles at Israel.
Which followed an Israeli strike on Beirut earlier.
Right. And it prompted immediate airspace closures all across the Middle East.
Now, impartially looking at the political side of this, President Trump urged both sides to avoid escalation.
Yeah, he claimed a final deal to reopen the Strait of Hormuz is very close.
Right, supposedly it could be signed by midweek. At the same time, the U.S. Treasury is weighing whether to seize Iranian assets to compensate Gulf allies.
But wait, I have to push back on this a little bit.
Go ahead.
When you look at these events missiles, sudden strikes, it feels like unpredictable, chaotic, natural disasters just hitting the market out of nowhere.
Yeah.
How do you even price that?
I hear you, but try to view it through a different lens. It's not actually random chaos.
You don't think so?
No, it's geopolitical brinkmanship as game theory leverage. Both sides know a Trump brokered deal might happen this week, so they are maximizing their physical leverage right before they sit down at the table.
Okay, I see that. So it's a negotiation tactic.
Exactly. But I will say, I think markets are pricing ahead of physical reality right now.
Because of the oil prices.
Yeah. Brent crude is sitting at $92.92 entirely on ceasefire hopes.
Yeah.
But the physical blockade is still there.
The ships literally aren't moving.
Right. And until they do, we're facing energy shocks as a delayed consumer tax. And that's just going to keep forcing the Fed to defend its central bank credibility as an inflation anchor.
That makes total sense. And those energy shocks are colliding with the other massive weekend story, which is this unbelievable AI spending spree.
It's just nonstop.
It really is. We have to look at this AI capex as a cycle-agnostic arms race. The tech giants are just spending through the rate hikes.
Yeah, let's detail those specifics because the numbers are wild. Friday, at 5:19 p.m. Eastern Time, reports broke that Apollo and Blackstone are funding a $35 billion debt deal for Anthropic.
$35 billion in debt.
Right. And then Sunday at 2 a.m. Eastern Time, OpenAI announced a massive ChatGPT super app overhaul.
And don't forget, Saturday morning at 10:57 a.m. Eastern Time, Elon Musk was slated to discuss his Terafab project with ASML.
Okay, but again, I have to challenge this whole narrative. It feels way too neat.
How so?
Well, yes, they're spending billions, but it's causing severe structural issues. Just look at Nvidia's CEO, Jensen Huang. Sunday at 6:28 a.m. Eastern Time, he warned of a multi-year memory shortage.
Which means the hardware is only getting more expensive.
Exactly. So to pay for this, companies like Alphabet and Meta are having to raise tens of billions in equity. We're talking about equity issuance as mechanical dilution here. You're literally diluting shareholders just to buy chips.
That's a really fair point.
And beyond that, look at the physical constraints. SpaceX just signed a $920 million a month cloud pact with Google.
Wow, per month.
Per month. The power required for that is insane. We're hitting a wall where energy access as the AI bottleneck is a real physical limit.
Right, you can't just wish a new power grid into existence. And, all this mega capex as a market liquidity drain is a real issue. All this capital is getting sucked into AI.
Yeah, it's draining the room.
And it's only being worsened by the violent yen devaluation we saw this week. The yen blew past 160.
Oh, right, the carry trade.
Exactly. We're seeing the yen carry trade as a global liquidity drain. People are having to liquidate U.S. assets to cover those yen-denominated loans.
So the market is really just caught in a vice right now between unstoppable AI spending and severe geopolitical energy risks.
It really is. So let's take a quick break, and then we'll look at the economic calendar for the week ahead.
All right, welcome back. Session 3. What are the key catalysts we need to watch in the coming week?
Well, if you look at the watch next items, Wednesday is massive. We get the U.S. May CPI and core CPI at 12:30 p.m. Eastern Time.
Which, given the inflation fears, is going to be heavily scrutinized.
Exactly. And that's followed by a highly supply-sensitive 10-year note auction at 5 p.m. Eastern Time.
Okay, and what about Thursday?
Thursday, we get U.S. May PPI, core PPI, and initial jobless claims, all at 12:30 p.m. Eastern Time.
And there's another auction that day too, right?
Yes, a very duration-heavy 30-year bond auction at 5 p.m. Eastern Time.
That's a lot of paper the market has to absorb.
It is. And then Friday finishes up with the preliminary University of Michigan sentiment and inflation expectations at 2 p.m. Eastern Time, plus the EIA crude and gasoline stocks and the Baker Hughes rig count.
Man, that is a gauntlet. As you set your alarms for Monday morning, just remember to pack light.
Pack late.
Yeah, you'll need your new AI-powered super app just to figure out how to afford $92 crude oil.
That is so true.
I mean, we started the week worrying if the Fed would keep rates higher for longer, and we're ending it wondering if we'll need to barter Nvidia chips to get shipping containers through a blockaded Strait of Hormuz.
It's been a long week.
Have a great Sunday night, get some rest, and remember, if the market's Schiller PE is above 40 while ballistic missiles are flying across the Middle East, your blood pressure probably is too.
Honestly, a very fair warning. Now, let's jump into our 2-minute bonus on-air session, paper trading.
Ah, my favorite part.
Just a quick recap. We started this internal experiment on April 17th, 2026, with $10,000 trading 13 macro ETFs.
Right.
Currently, the portfolio sits at $10,841.24. That's an 8.41% return, which is outperforming the S&P 500's 3.62% return.
Not bad at all. So I'll go first with my trade. I am officially selling 10% of my tech exposure, the XLK ETF, and I'm buying 10% healthcare using XLV.
Okay, walk me through the justification there.
Well, the portfolio is just dangerously over-concentrated in tech. We're at 42%. And with rate shocks bringing discount rates as financial gravity, plus equity issuance as mechanical dilution weighing on tech, I really want some capital protection.
Makes sense. Healthcare is definitely more defensive.
Right. It ignores the new June 8th metal tariffs, and it completely dodges the energy shocks as a delayed consumer tax.
Well, I agree with you on selling tech, but I'm choosing a different destination. I am selling 10% XLK, but I'm buying 10% energy using the XLE ETF.
Oh, interesting. Why energy?
Because of the geopolitical brinkmanship as game theory leverage that we saw this weekend,
Mm-hmm.
those ballistic missiles mean I want an immediate geopolitical hedge against a Monday oil spike. Plus, if we're looking at energy access as the AI bottleneck, XLE is just a structural necessity right now.
That's a great point. Okay, so stating the aggregated final decisions from Monday's close, we are selling $1,084.06 of XLK.
Which is 10% of the portfolio.
Right. Then we are buying $542.06 of XLE, which is a 5% weight. And then buying $542 of XLV, another 5% weight.
And as always, a swift reminder that this is a live experiment and absolutely not financial advice. Please do not copy these trades.
Well said. To wrap up this deep dive, I want to leave you with this. If tech companies keep having to raise billions just to secure enough electricity for their data centers, are we moving into an era where the energy grid, not the Federal Reserve, dictates the ceiling of the U.S. economy? We'd love to hear your thoughts and your own macro thesis, so drop them in the comments below.